Concerns over Europe sent the euro to a two-year low versus the dollar, and the price of U.S. Treasuries, America's government debt, jumped, sending yields on 10-year notes to a new low of just below 1.4%. That new low is because the global slowdown has investors so worried that they're putting money in U.S. government debt even with such a low interest rate. Investors are willing to settle for returns on their investments that probably can't even keep up with inflation. Karina Huber has more.
If you bought a 10-year U.S. Treasury note on Monday, you would be paid as low as 1.4% interest on that investment. That's a little less than the current rate of inflation, meaning you will actually lose some money by buying that bond. Nevertheless, demand remains high for U.S. government bonds because uncertainties in the global economy make safe investments hard to come by. Investors are more concerned about keeping what they've already earned, a strategy that portfolio managers call capital preservation, than making any gains. While the demand for U.S. bonds continued to grow on Monday, the demand for U.S. stocks fell, and it could remain low for some time.
There's an old adage on Wall Street that says, sell in May and go away, meaning the equity markets tend to cool down in the summer, but then pick up in the fall. But market participants say this year is different, and they do not expect Wall Street to rally come September.
Kenneth Polcari is a trader on the floor of the New York Stock Exchange.
The expectation today is, in fact, that Greece is going to pull out of the Eurozone by September. Well, that's not going to help anybody because although everyone says, the horror of Greece pulling out is already priced into the market and everyone's comfortable with it, the fact is we've only seen the creation of the Eurozone over the last 12 years. We've never seen a country come out of the Eurozone.
From a technical standpoint, experts like Richard Anthony say it doesn't look like the U.S. stock market is headed for a rally. He analyzes the VIX, an index that measures fear in the market. A higher VIX index means more fear. A high VIX also can cause a rally because investors assume the market has hit a bottom and stocks are cheap. Anthony says despite all the uncertainty in the world, the VIX is at a relatively low level, which is not good news for those hoping for a rally.
If we have VIX at this level entering the fall, I would be betting that you'll have a probability of a fall decline. But if you see a decline prior to the fall this summer and VIX up into the 30s or 40s, which I don't think will happen, then you will see that rally.
While there is no way to know for sure where the markets will go, what does seem certain is Wall Street is in for a bumpy ride until there is a resolution to the European sovereign debt crisis. Karina Huber, CCTV, New York.